America's national debt is exploding past $36 trillion. And now, a bold new idea is catching attention inside of Washington. One that links treasury bonds with Bitcoin. It's called Bitbonds. They look like regular US government bonds, but under the hood, they're built to stack Bitcoin automatically. No crypto wallets, no exchanges, just a government-backed bond with Bitcoin built in. According to the proposal, this structure could help the US buy $200 billion worth of Bitcoin while saving an estimated $350 billion in interest payments. Sounds pretty good to me. And here's why it matters now. Remember, guys, according to the executive order, it said the US shall look for ways to acquire new Bitcoin without raising taxes or dipping into public funds. And Bitbonds could be the perfect vehicle for that mission. This could change how the US funds its debt, how everyday Americans gain exposure to Bitcoin, and how trillions in global capital start flowing into the next monetary era. Let me show you exactly how it works and why some people believe this could be the most important financial idea of the decade. Here's what Bitbonds actually are. And some people are calling this one of the most creative financial proposals Washington has ever seen. At its core, a Bitbond is just a new type of treasury bond. You know, the ones the US government sells to raise money. You give them $100, they pay you interest every year, and after 10 years, you get $100 back plus your interest. That's how it's worked for decades. Pretty straightforward. With a Bitbond, the US government still borrows $100 from you, but instead of paying you the usual 4 to 5% in interest, like a regular treasury bond, they pay you only 1% a year. Now, I know what you're thinking. Why would anyone accept such a low interest rate? Because there's a twist. The government takes $10 of that $100 and uses it to buy Bitcoin. You still earn 1% interest each year. You still get your full $100 back after 10 years. But if Bitcoin goes up in value, you get to share the upside. Now, here's the important part. After 10 years, you receive 100% of the Bitcoin upside until your total return hits 4.5% annual compounded rate, about $155.30 on a $100 bond. Any Bitcoin gains above that point, you split them 50-50 with the US government. Sounds pretty good, right? And what if Bitcoin goes down in value? You're still protected. Your $100, it's guaranteed, along with your 1% interest rate, because the government takes on the Bitcoin risk. If Bitcoin underperforms, you don't get any bonus from that $10 slice, but you don't lose anything either. That's the beauty of Bitbonds. It's a familiar government-backed asset with a little Bitcoin kicker built in. No wallets, no passwords, no crypto exchanges, just a simple bond with upside. It's kind of like a savings bond with a scratch-off ticket attached. You're guaranteed safety, but if Bitcoin does well, you win even more. And that's the genius of the design. It helps the US government reduce interest costs, and it gives everyday Americans a safe, regulated path to invest in Bitcoin without any of the usual crypto complications. Bitbonds were proposed by Andrew Hohns, CEO of New Market Capital, and he's not alone. Matthew Siegel from Van Eck has also floated the idea of backing US bonds with Bitcoin. Different proposals, same direction. Bitcoin is becoming part of the financial system's blueprint. This is incredibly exciting. In a 10-year bond, Bitcoin has always done well over 10 years, right? So why is the idea even being proposed? The US is facing a financial problem, bigger than most people realize. We're sitting on over $34 trillion in national debt. And just the interest now costs over $1 trillion a year, more than the US spends on defense. And as more of that debt comes due, the Treasury has to refinance it at today's higher interest rates, making it even harder to manage. Meanwhile, the US has already approved a strategic Bitcoin reserve. We know this. Officially recognizing Bitcoin as a long-term asset worth accumulating. But here's the thing. The government, they haven't bought any Bitcoin yet. So now proposals like Bitbonds are gaining attention because they offer a path forward that doesn't rely on raising taxes or printing money while still allowing the government to borrow at lower costs. And that's exactly why the government might want to move forward with the Bitbond proposal, offering you less interest while giving you upside. With a traditional bond, they might have to pay you around 4% a year. With a Bitbond, they could pay just 1% and allow investors to benefit from Bitcoin's long-term growth. If Bitcoin performs well, which on this channel we think it will, everyone gains. And if it doesn't, they still raise money at lower cost. This creates a more flexible tool for financing, one that lowers interest expenses and helps the Treasury gradually accumulate Bitcoin. Of course, bringing a proposal like Bitbonds to life would require significant regulatory consideration and bipartisan support to move through the legislative process. So if this proposal really does help the government save money and build a Bitcoin reserve, the next question is, who exactly would this be for? Who stands to benefit from Bitbonds? And why might everyday investors actually want them? Let's say you're not a hedge fund. You're not a whale. You're just a regular person with a savings account, maybe a retirement plan, trying to grow your money without taking wild risks. That's exactly who Bitbonds could be designed for. Because right now, if you walk into a bank and open a savings account, you're lucky to earn even 0.5% a year. I mean, that's generous. A 1-year certificate of deposit might offer around 1.8% according to the FDIC. Not bad, but really bad actually, but still capped with little room for upside. And if you go for a 10-year treasury bond, sure, you'll get around 4% interest, but you'll also get taxed on those earnings. Now, compare that to what Bitbonds could offer. You'd still earn 1% interest annually, but under the proposal, that interest could be tax exempt, along with any Bitcoin gains. Wow. And if Bitcoin 5x's over the next decade, your overall return could approach nearly 5% a year, rivaling or even beating most traditional savings tools. That kind of potential, paired with US government backing, makes Bitbonds an interesting option for savers who want more than just fixed interest. But it doesn't stop there. Bitbonds could also appeal to institutional investors, pension funds, insurance companies, and banks, the kind of entities that already buy treasury bonds by the billions. For them, Bitbonds could serve as collateral, provide inflation protection, and offer exposure to Bitcoin, all in a very familiar package. And then there's a Bitcoin community. For long-term holders, Bitbonds could act like a Trojan horse, slowly moving Bitcoin exposure into retirement funds, fixed income portfolios, and even central banks. It's not a substitute for holding Bitcoin directly, but it could be one of the easiest, most tax-efficient ways to gain long-term exposure without needing to worry about custody or complex infrastructure. So whether you're a cautious saver, a fund manager hunting for yield, or a Bitcoiner looking for passive exposure, Bitbonds could be the bridge between the old system and what's coming next. Just buy the bond and let the upside take care of itself. And here's something almost no one is talking about yet. If Bitbonds become real, this could be the biggest unlock of all. And right now, US Treasury bonds, they're not bought by just Americans. They're held by governments, central banks, and sovereign wealth funds all over the world. In fact, foreign countries collectively hold over $8.5 trillion in US Treasuries, with Japan holding over $1 trillion themselves. And countries like China and the UK and Canada, they're not far behind. Now, imagine this. What if Bitbonds captured just 5% of the foreign held US Treasury market? That's $425 billion. And if 10% was allocated to Bitcoin under the Bitbond structure, you're looking at $42.5 billion in demand flowing directly into Bitcoin. We're talking about nation state level demand for Bitcoin. the kind that dwarfs any individual whale. This demand could be a steady bid that builds over time. And here's the most important thing. As you may likely know, only 21 million Bitcoin will ever exist, with likely 4 to 6 million of them already lost forever. So if you're holding Bitcoin today, Bitbonds could be the trigger that sends demand absolutely soaring, all while supply continues to tighten. And we're not just talking about fund versus fund competition anymore. This could set the stage for a full-on nation versus nation race to accumulate Bitcoin. Because once countries realize that they can use US bonds to gain indirect exposure to Bitcoin without cold storage, private keys, or regulatory headaches, that opens the door to a whole new game. Bitbonds don't just normalize Bitcoin. They make it more scarce, more valuable in demand, and possibly more valuable than ever. And to all the Bitcoin holders out there, you're early and well-positioned. If Bitbonds take off, you might just watch the world scramble to chase what you already own. So, ladies and gentlemen, let's recap. Bitbonds represent more than just a new type of treasury bond. They could be a bridge between legacy finance and the Bitcoin economy. For everyday Americans, they offer a new way to get exposure to Bitcoin through a format that's safe, familiar, and backed by the US government. For institutions, it's a compliant path to tap into Bitcoin's upside without needing a new infrastructure or custody risk. And for the US government, Bitbonds offer lower interest costs, potential upside, and a creative strategy to build its Bitcoin reserve, using demand from investors, not taxpayer money. If other countries begin adding Bitbonds to their portfolios the same way they held US treasuries today, that could unlock billions in demand for Bitcoin and position the United States at the center of a new global financial system. Whether or not this gets approved, something important is already happening. Financial policy is evolving. Bitcoin is stepping into the spotlight, and new tools like this could reshape how the world thinks about debt, savings, and digital assets. What do you guys think about Bitbonds? Let me know in the comments below. Would you consider buying one instead of buying Bitcoin directly? I'm curious how you would approach it. And if you found this breakdown helpful, don't forget, guys, to do me a favor, hit that like button, subscribe to the channel if you're not already. My name is Chasse. What's up? And share this video with someone who still doesn't believe in Bitcoin. Thank you guys for watching. I really appreciate it. Stay sharp, stack Satoshis. And someone asked in the comments, what are sats? Sats are Satoshis, which is the smallest denomination of a Bitcoin. 1/100 millionth of a Bitcoin is 1 Satoshi. So if you can't stack Bitcoin because you can't buy a whole Bitcoin, you can stack little bits of Bitcoin, right? And the goal is to value your wealth in Bitcoin and accumulate as much Bitcoin over time as possible, because for everything that we've been talking about, everything that we talk about on a regular basis, all roads point to one thing: Bitcoin being extremely more valuable and a higher price than it is today by an order of magnitudes. I'll catch you guys in the next one.